Welcome back to another episode of the Travillian Next podcast. I'm very excited to bring an old friend onto the podcast today, Mr. Brad Hanson himself, who probably predates every banking-as-a-service nerd out there by 2 or 3x, was probably starting this before it was even a good idea. Just kidding, obviously, Brad. But thanks for joining. Brad, I have a ton I want to touch on with you today about the current state of the environment, innovations for the future. But first, I thought it'd be great for you to just kind of introduce yourself. Obviously, you had a lot of involvement with, some of the larger banks that are out there in this world, Bancorp, Pathward, at certain points in your career. But maybe start at the beginning for us. Tell you how you got into all this, and then we could take it from there.
Sure. Well, I got started in banking at a bank called BankFirst. BankFirst became what is now the Bancorp. BankFirst, I started a number of different businesses. It was a very, very small bank when I went there, but we started a mortgage lending division and some other things, and then we ended up starting a large credit card operation. As that grew, obviously South Dakota is a big place for credit card operations, and Citibank was here, and a lot of executives came over from there. We became one of the largest credit card portfolios in the country, and I became very heavily involved in our IT or technology associated with the bank. A little later on, I was asked to find the next thing the bank was going to get involved with as some of the regulatory challenges around subprime credit cards was facing the bank, and that's when I discovered prepaid cards very early on, back in 2004 probably. 2000 and maybe 2000, I guess, was probably the first time we just started thinking about that. I was looking in adjacent industries like acquiring and found people trying to sell gift cards in order to get the acquiring business. Started researching that and found a company called Wildcard Systems, which was ultimately sold to Fiserv. But Wildcard Systems was one of the very first platforms developed for prepaid. And they were looking for a bank to help them create what is now the flexible spending account cards. And those were very new to the industry. No banks would take it on or could understand the risk associated with it. And I found it fascinating idea to try and get involved with them to support that program. As we developed that program, I came up with this concept that everybody was going to the processors that were created. Like in the early days, there was FSV, which was bought by U.S. Bank. There was Galileo, who is now part of SoFi. Everybody's selling, but right. there were processors like that, and people were going to the processors with their fintech ideas and wanting help developing that and getting access to the MasterCard Visa networks through the processors, and the processors needed banks. And banks didn't understand the risk profile in this industry. So we started connecting to all the processors, and that's how we started getting business, by connecting directly to them. Everything that MetaBank did was making sure we had a direct contract with the processors that could be utilized. We didn't let those be directly controlled by the Fintechs. We had agreements with the processors and other primary service providers in addition to the Fintech that we were sponsoring as a banking as a service. So that's kind of how we got involved with that. Early on, I moved from BankFirst at the time, as they were trying to sell their credit card portfolio and sell the bank to what is now Bancorp. I moved over to MetaBank and started a program in 2004, and that obviously became, I guess those two banks obviously became the two biggest banks in the fintech, prepaid, or banking as a service industry over the years.
Yeah. And I don't know that we'll figure out on this podcast what to call this thing, but let's just call it banking as a service, just for the simplicity of of it all. But when you started this concept, Brad, when you helped start this concept, what do you think? Banking tends to be commoditized, right? And I think the banks that do the best have a really good value proposition. And what do you think the value proposition of banking as a service was in your eyes? And then, the follow-up to that is as you look now, kind of from your objective seat, having moved on from Pathward, formerly Meta, and some of your other stuff you were doing in the States, how do you think the industry's doing at carrying out that value proposition in your eyes?
Well, first of all, back in that day, there were not a lot of almost no regulations around banking as a service or around the sponsorship model in prepaid. The only thing similar was the ISO model in acquiring. ISOs, independent sales organizations, were going out and selling the acquiring services to merchants, and they were sponsored by a bank. And that was the similar model. There was a lot of inherent risk, perceived risk and real risk back in that time frame in that industry. And the regulators were very concerned about banks getting involved in the ISO sponsorship business. So it was really managed or controlled by a few larger banks and specialty banks in that space. And when we started getting involved in this, we started thinking about what do you call this whole relationship between the fintech and in the prepaid space and the bank. And we didn't want to call it an independent sales organization because we didn't want the regulators to stop us before we got started, kind of likening it to the acquiring industry and the inherent risks there. The risks are totally different in prepaid than they are in acquiring. But we didn't want that, that name, I guess, to be a red flag to the regulators. And that's when we came up with the term program manager to form that relationship, which is really what they're doing. They're managing those programs. The Fintechs are. They're managing the customer service and the different elements, and the bank is overseeing and managing them. And that's one thing I think some forget. The same way a regulator manages the bank is required and responsible to manage the third party. That's why we wanted those agreements with all those critical vendors and elements of the program, and we wanted specific controls in place that would put the bank in charge ultimately of what was going on with those programs.
Yeah. It definitely, you look at the regulatory scrutiny on some of these banks now, and it's very objective that that's the situation that occurred, right? Is like that the oversight, the branch of oversight didn't quite go far enough. But I know, but I also know in when I think I got first introduced to Meta and you in 2015, and a big element of what you guys were talking about was reaching underserved members of the banking community and how this sponsored prepaid model or banking as a service was a big component of trying to address that. And I think that still seems to be the case today, which I think is a testament to kind of the truth of how that view started. But what are your thoughts there?
Well, I always said that I'm a bit contrarian, a bit of a contrarian, probably a strong contrarian. So I said, I don't want to go where all the other banks are. Everybody else is already served by Citibank and Wells Fargo and Chase and, et cetera. There's not really that much room for the small guys. There's little pockets, but if you want to scale, it's not there. I want to go where they aren't. And that's why we targeted that that population in the first place. And then, so it wasn't necessarily as altruistic as you think initially. It was more that's where the opportunity for us lies.
Yeah.
And also back then, similar to right now, but back then, Fed funds was over 5%, and you just, you could bring in free deposits. You weren't sharing deposits or paying interest to the program managers or anything back in that time. In fact, they were paying you. You were sharing an interchange, so you were getting paid to take deposits and then reinvesting them in Fed funds if you wanted at 5.25% and making a huge interest margin. Little did we know that a few years later that rates would go to zero and stay there for over 10 years. But
although it's probably good that you were in securities and Fed funds in 2008 and not construction loans.
Well, it really was. We weathered that really well because of that. But at the same time, when your model drops like that, and your revenues are getting squeezed by others coming into the industry, you really needed scale in order to be able to justify being in this space at that time. A lot of people thought, oh, they're just getting easy deposits. They didn't realize the amount of investment, the amount of people that it takes to manage and operate effectively in this space, and how expensive it is, and how much scale you needed in order to be able to support that kind of industry. And that's still today, I think, the case. Some banks today, I think, where they make mistakes is they think, oh, we got to get into this fintech thing. It's a place to get deposits. It's a easy money. It's not. They think banks, typically there's an arrogance to banks. We know compliance, we've never had a problem, but this is different. You wouldn't get into acquiring even today if you didn't know what you were doing or hiring the right people, and prepaid's the same. It's not just another deposit account. You've got the third parties, you've got different customers, they're coming through different channels, and you really need to have the expertise to manage it. And if you think you can do it, you're going to end up with problems. And that's why almost every single bank that has gotten into this has ended up either under a regulatory order or some kind of MRAs requiring them to add that expertise and develop that. And if they don't have the scale to support it, those deposits all of a sudden become pretty expensive as opposed to attractive.
Well, I think another big change too is when you guys first started and came in and 2015, 2016, I remember Meta, now Pathward, took a pretty big jump. You had some H&R Block, like the H&R Block part. There were some bigger names, and it really started to gain some steam. But the competitive dynamics of the world now, like most of these deposits are Fed funds minus, maybe 25, maybe 50. I mean, it's still a pretty good, sticky, granular funding source, but it's not zero. And so I think one element that I've seen that's interesting is, you guys, I don't want to say got away with, but the asset strategy took a lot of time to develop, and frankly, it's still, I know you're not involved anymore, but over at Pathward, it's still taking twists and turns, on the asset side. But, back in 2015, I think you guys had almost 55% of your assets in securities at one point. And it was fine because the cost of deposits was zero, and you guys were growing revenue and earnings, but now I think there's a lot more, not stress, but there's a lot more focused on the whole picture of these companies. And it's like, well, what's your asset strategy? What's your credit risk? What's like the long-term ramifications of growth? And I think those are healthy things to come, but it's also kind of a different phase of where it was back in 2005 to 2010, when it was more exciting. And, I've always, you've heard the story, and those who know me probably have heard the story, but I remember being in that staff meeting with the KBW's old director of research, Fred Cannon, and they were like, who's going to cover Meta Financial Group? And I was the only person that raised my hand because bank people hate things that look different. But I was young and I was interested, and I was looking at this bank that has so much non-interest-bearing deposits that they have to have 55% of their earning assets in securities. Like, I was like, what the hell are they doing? And I want to find out more. But that has changed a little bit, that dynamic of the asset side and rates not being zero anymore and what have you.
Well, it has. I think that you mentioned a lot of different things there that play into this, but I don't know what their strategy is today, but I think that once you start, so let me go back to this. Meta was a publicly traded company. I always wished we weren't, because the market had a hard time digesting that business model. We weren't. You just said it. People don't like things that are different. They don't want to go to work to understand it. It doesn't make sense in relation to what everybody else is doing. And like I said, I don't want to be where everybody else is. I don't want to follow the crowd. I want to go and pave our own way. The problem is that you lose a lot of investors just because they don't want to take that trouble to understand it, and don't trust that because it's different that it's going to work. And so I think being public was a challenge because you went with the whims of the market. You went with, sometimes there were shorts in there, sometimes there were other things that you couldn't control, even though the underlying value proposition, the profitability, and everything else was great. I look at what's caused bank troubles. You look at, Silicon Valley Bank's issues and the concentrations that were there. And I think one of the misnomers is people look at the fintech, like, you mentioned them, an H&R Block or a NetSpend or whoever that's got a big program, and they think they're the ones with the concentration. It's not, because the bank owns the underlying accounts. And so you've got more diversification in this model because of all the millions and millions of different individual accounts under there than people think, which makes it much easier to manage your liquidity risk and your concentration risk, and to be able to go out a little bit in some of those investments. You're not going to get a call of all those millions of accounts coming back at the same time. It's just like any kind of portfolio management, credit card portfolio management, or any other checking account portfolio management. It's pretty stable stuff, and it's proved that out over different cycles, different economic cycles and everything else over the years. And none of these guys, NetSpend, et cetera, have been able to lock, stock, and barrel just take a program and go. That doesn't happen, and it can't happen because of the way those are structured. And it's very, very costly and expensive for them to try and move away from their existing relationships. So becoming great partners and developing those relationships and making sure that everybody is playing their part to support those individual customers is much more important. That's, I think, some of the things the regulators have missed when they look at these risks. Yeah, the banks have to do their part, but I think the regulators should be helping the banks, not so scared of banks getting involved and trying to make sure they aren't there. And they would argue that they're just making sure the banks put the right, processes in place. And that's probably true. I always thought of the regulators as the fourth line of defense, I called it. For example, you've got your 3 lines of defense, your operations, you've got your management, you got your audit, you got your external audit, and then you've got the regulators. And I always thought they come in with an independent set of eyes into our business. They're looking at banks all over the place and see different trends and see different things that we don't from inside our place. And so I always viewed their input as an opportunity for us. I didn't like it when we got criticized or when we had trouble, but I always took it and said, okay, we're going to build off of this, and we became a better bank for it every time. So I think they can be helpful in that process, and I think they should work more collaboratively with the banks rather than just acting as an overseer or a guardian of the banks.
Yeah. Well, I think they over-index, right? So, like, evolve happens, which obviously is not good, not a good situation. I mean, we don't have to delve into it here. There's plenty out in the public sphere about what's going on there. But, I think their mindset from afar seems to not be, well, let's help these other banks not become evolve. Let's go find the next evolve. And then they're looking at every other bank thinking, like, this could be another evolve, right? It's like, well, no, like, that was an isolated incident. Yeah, you should be looking for other banks that are not putting the proper oversight in, but in reality, it's and I think some regulators have done better than others. Like the Fed, from what I've heard, the Fed's Novel Activities Group comes in and asks pretty good questions and is pretty plugged into what's going on. I think that's kind of what you're talking about. It's helpful when someone plugged in to what others are doing can come in and look at what you're doing and give you feedback. But I think it shouldn't be when it's almost like a witch hunt, which probably is not the best term, but when it's almost like a witch hunt, there's no question that the kind of the innovative juices of the industry are going to take a big hit, which, I imagine, I don't want to speak for you, but I imagine it's partly why, when you left Pathward and were looking to do something else, I think you got involved with a bank in Mexico, which I did want to ask you about because, not that I think we have a ton of bank investors and executives in here that are looking to do the same, but it's sometimes that fresh perspective can be interesting. And so maybe tell us a little bit about the bank in Mexico that you're involved with, but any kind of really one or two key takeaways from your time there that you think has opened your eyes to something new or illuminated an idea that could be relevant in the U.S. that you think we're not kind of focused in on?
Well, before I do that, first of all, the regulators in the U.S. have developed at this point, I think, an understanding, and they've developed a playbook for banks. They've given a lot of guidance if you go get it and follow it and pay attention to it. I think a lot of companies, a lot of banks don't take that time and trouble, and that's part of what creates their challenges. And the regulators pretty quickly identify the banks that are not following all those requirements and guidance that's been laid out for them already. So take advantage of that if you get into it. But I went to Mexico because we were serving so many customers who were either immigrants or unbanked and not new to the banking system altogether, because they had come here from countries where they don't trust banks and needed those relationships, those third-party relationships, in order to create that affinity and trust, because they don't trust banks. They didn't want to. They even sometimes view banks as an extension of the government and don't want to be on the radar and other things. So they want that sense of anonymity and sometimes affinity and trust that they have with some of these fintech opportunities. As I watched what's going on with those guys and watched that going on in other countries, I have relationships down in other countries and with people through my time and through my introductions over the years. And I wanted to try and extend the opportunity to people in those countries to be able to have access to financial services and help them, grow their opportunities. And I found that the need is even greater. I mean, you go to some of these countries, and I was in Guatemala trying to learn some Spanish, and noticed as I came home on a Friday that there's a line of people in the center square of the town going for about 2 blocks long, people standing in line, and they're all ending up at the Western Union. And they're all waiting to get their remittance that's coming through from from their relatives here. And the average remittance being like $320. And when I found out how much of that $320 at the time was going to pay for fees to Western Union, I was thinking, man, there's got to be a way. If I could cut that fee in half, it's like several days worth of pay to these people. That's what these people literally are living off of. Some of them, a lot of them. A lot of people are living off of that distribution or that remittance coming from the United States. Even when I went to Mexico, we had some of the people, our average pay was in the hundreds of dollars, not thousands of dollars a month. And, we can't comprehend that here. It's really hard. So every dollar of cost to these people makes a difference. Opportunity to save their money, because cash is so expensive to use. It gets lost, it gets stolen, it's inconvenient. It costs more to you don't earn any interest off of it, nothing. So to bring them in the system and give them a safer way, a way to save, a way to create, some kind of a banking relationship, to me was an opportunity I couldn't pass up. And I had an opportunity to get involved with a bank there and help them get their license, which came in 2019 actually, when they got their license. And so I left Meta when we took my early retirement, and I had reached that point that I qualified for that, and decided to go down there and see what I could do to help that model in Mexico. That bank is doing a lot with this now. It's growing tremendously. I'm on the board there, but I haven't been directly involved in management for a couple of years now because I learned I don't speak Spanish, so I had translators and other things, and it was just so efficient. And you can't sit down one-on-one and get your point across, and you can't have a come to Jesus meeting with somebody, and you can't. It's just so hard to communicate through a translator at a time, and everything took twice as long, and it was just very cumbersome. And I just learned that it would be better to bring in some management people and then just provide that, kind of high-level vision and oversight from the board than it would be to be in management there. I did, decide to come back here, and I've spent some time on some boards here and others with some Fintechs, quite frankly. Some of them even old customers of MetaBank. And so now I've seen the industry from the other side in the United States as well, and I feel like today I have a really well-rounded vision from bank to international to the fintech side of this entire industry. And I've learned that from the there are fintechs, I'm sure, that don't take it seriously. There are some that just happen by ignorance or accident, some issues that go on that we've seen with some of these fintechs. But for the most part, the serious ones, the ones that either gone public or have, serious investors or others, those guys take this very seriously. They take their compliance seriously. They take their business professionally and seriously, and they want to be great companies. And I've seen how they try and do that and how they try and cooperate with the banks and work with the banks. So I don't think the regulators should look at these guys as just a bunch of, uncontrolled bad, risky, actors out there. They're creating some great technology, some great products and services that can be introduced to people that need them. And I think under the right circumstances, this whole ecosystem can be a very valuable asset to the country.
Yeah, I couldn't agree more. I mean, it's why I still do a lot of the work I do, and I honestly, I'm thankful for being introduced to you guys and Tyler Haar and Glenn Herrick and all the executives. You guys were probably at Meta at the time, my first introduction into this whole thing, and opened my eyes. But given all your perspectives now, where should bankers be running? You made a career out of running where others weren't, and thinking outside the box, but doing it in a way that was safety and sound, right? And so what are some of the opportunities in the U.S. that you see today that interest you, that excite you, that you think are maybe underserved? Is there still a lot of the same, or there's some new ones? What are you willing to share?
Well, I think, first of all, bankers should understand it's okay to stay in their lane, too. I mean, do what you do what you know, and do it the best you can. There are different, there's going to be some out there that have a propensity to try and do some innovative stuff and some other stuff and want to get involved in other activities. Make sure you build your highway before you drive on it. I guess that's what I would say. Make sure you make those investments. You bring in the experts, you bring in the people, you have a little humility and admit you don't know everything. And then once that's built, then you can go, be much more effective when you get involved and have a lot less risk and regulatory issues as you go along. That's, I think, the thing that's missed by a lot of bankers getting involved in this. The other thing is I've seen some be very effective at having some smaller portfolios, staying focused on those, maybe fewer, when I say that I mean fewer relationships, and just trying to grow those fewer relationships rather than spreading so thin. One of the very costly ways of getting involved is just taking everybody. It's harder to manage so many third parties, and then if they're using all these different vendors, how do you connect to all those different vendors and make sure the right things are going on, manage that? And quite frankly, one of the requirements of the bank, and probably the most challenging requirement we had to overcome as we grew, was how do I understand who my customer is as the bank? If my customer is Mike Perito, and Mike Perito has an account through NetSpend and another account using, a program on Galileo, and a checking account maybe, or a savings account at the bank that's on Fiserv on these disparate platforms, I need to know all three of those accounts on those disparate platforms are Mike Perito, one customer of the bank, and I need to be able to combine that profile and understand Mike's activities and Mike's banking relationship with me as one. That is extremely difficult. So the further you spread yourself amongst different processors and program managers and everything else, the harder that becomes to understand who your customer is anymore, the more costly it is to oversee all that, the higher risk profile you're going to have. Staying in your lane, I think, is really important. Understand what you're going to do, and if you are going to do that, building out those capabilities so you can fulfill your responsibilities effectively is critically important if you want to be in this business.
Yeah. No, I think those are wise words, Brad, and I really appreciate you joining us today as a blast from the past. But it's really, I think it's a really fascinating area of banking. It's grown a lot. It certainly has went through a challenging couple of years. But when you look at some of the names of companies that are starting these partnerships still in the United States, I think it's very safe to say, that this type of banking is not going anywhere, and it's the world continues to evolve. People want safety, they want soundness, but they want digital access. They want things that some of these traditional banks aren't really able to interject into, from like digital ecosystems and communities and things of that nature. So thank you so much for joining us, and I have a feeling we'll be maybe seeing you a bit more stateside, hopefully, but thank you.
Yeah, maybe next time we'll be able to see what's going on with AI in banking and how that's going to be effective, both from a security perspective, but also from a user perspective. I think that's going to be a very fascinating thing to watch in the years ahead, and I'm excited to see it.
AI is definitely on our 2025 list of possible topics for this podcast. But thank you, everyone, for joining us. Happy holidays, Brad. Happy holidays. Great to hear from you, and look forward to chatting more soon.
Thanks a lot. Take care.